It is Thursday, July 28th. Apple and Amazon both report earnings after the market closes today. In this video, I'm going to talk about the earnings expectations for both of these companies and some things investors should be thinking about and watching out for because one of these companies looks very overvalued. Here's Apple. Right now, we're looking at Apple's earnings expectations. We can see the stock's at $156.90 a share. It's just barely flat today. Last quarter, they reported EPS normalized at $1.52, which was a beat by 9 cents. That was on April 28, 2022. They also beat on revenue. They beat by $3.28 billion. They had $97 billion in revenue. This quarter, they're expecting normalized EPS of $1.15. Q3 tends to be lower than Q2, and Q2 tends to be lower than Q1 just because of the time of year they report. So that part's normal. They're also expecting revenue of $82.97 billion, which is also down. Talked about why that's okay. Let's look at the company's earnings history. Just a very clean record of beating expectations, both on earnings and revenue. What investors are going to be looking for, and analysts are going to be looking for, is do they hit this $1.15 EPS target, and do they hit that $82.97 billion in revenue? And then they're also going to look at, do they provide any indication whatsoever about whether the rest of the year looks strong? This is currently the analyst EPS estimate for 2022, 613. And then the revenue estimate is $393 billion. If Apple talks about weakening demand and customers not wanting to spend money and supply chain issues, that's going to likely bring these estimates down, which could be bad for the stock price. We'll get into the current valuation in just a minute. So let's look at Amazon. They're kind of a different story. They missed last quarter on EPS and revenue. They had minus 38 cents in EPS last quarter, and they're actually, analysts are expecting it to be positive 12 cents this quarter. They had 116 billion in revenue last quarter. They're expecting 119 billion this quarter. Let's see their earnings history. So it's been a little bit of a rougher road in terms of missing analyst expectations. They've actually missed revenue expectations for the last 4 quarters. Another miss would be a pretty big red flag. Let's jump in and see how these stocks look. They talked about one being overvalued. Which one is it? Well, I think Apple is overvalued, and if they disappoint, I think the stock could see a pretty big drop. And if that happens, that's going to cause the entire market to be down tomorrow. What we want to do is get an idea for Apple's average earnings growth rate each year. If we go back to 2016, that's what we're looking at now, we can see that their earnings growth rate has been about 17%, 16.5% per year. And over that time period, that normalized, that price earnings ratio has been 19 on average. Right now, it's trading at a price to earnings multiple, a blended price earnings multiple of 26. That is almost 30% above its average. That's kind of yellow flag number one, right? If we go to forecasting, we can see that the expected earnings growth rate is about 8% over the next 3 years. If that's the case, and if Apple were to trade down to its average price earnings ratio from the last several years to about 1950, you're actually looking at a negative return in Apple over the next until 2024. But if Apple comes out and warns about earnings, or they warn about the supply chain or whatever, and these estimates come down and they miss these estimates, the stock is potentially drastically overvalued. I'm not predicting that that's what's going to happen. I just want to highlight that as something for investors to be aware of. All right, let's run through Amazon. Amazon looks, extremely undervalued. It's better to look at Amazon from a price to operating cash flow metric. It's been 27 historically, but even if you just look at 15 and you look at the operating cash flow, the expected growth rate of 48%, 42%, and 27% for the next 3 years, even if you just have that at 15, way down from the 21 currently, if they get that type of growth or even less growth, you're still looking at an 18% annualized return, a 50% total return through 2024. If we go to forecasting, and we see that it's at a blended price operating cash flow of 21 right now, even if we bring that down to 14, you're still looking at a positive return. If it stays at 21, then you're looking at a 34% annualized rate of return.